The case was is your space to explore real-world business events, decode disruptions, and uncover timeless management insights. Our mission: build critical thinking, scenario analysis, strategic perspective, and sound decision-making, the foundations of leadership excellence. Each video presents a case from current business reality, distilled into clear narratives and linked to proven management frameworks. Whether you're a student, teacher, manager, entrepreneur, or thought leader, the case was helps you analyze, reflect, and stay ahead with actionable insights. Here, business is not just studied, it's experienced, questioned, and reimagined. Join our community where every case holds a verse, and every verse shapes the future of business. Courses for discussion. The case is suitable for use in the subject of corporate turnaround. Target audience. The case has been designed for audience encompassing MBA students, management scholars, corporate strategy and turnaround strategy enthusiasts, entrepreneurs, business leaders, strategic thinkers, teachers and scholars in business management. Slide 3. Case domains. This case encompasses the domains of strategy and governance. Theoretical lens framework applied. This case leverages Bybolt's framework, corporate turnaround framework, Slater and Lovett strategies, corporate turnaround framework. The said frameworks can be used to analyze and interpret the scenario. Learning goals. By the end of this session, students should be able to understand how a corporate turnaround unfolds through sequenced interventions. Apply Bybolt's 5-stage turnaround model to diagnose where RInfra stood and why particular actions were prioritized. Use Slater and Lovett's turnaround strategies framework to map the operational and strategic levers employed. Appreciate the interplay of governance credibility, financial restructuring, and external validation in a turnaround. For a free copy of teaching note for this case, mail at thecasewasone@gmail.com. Reliance Infrastructure's turnaround, a case on capital, control, and credibility. By mid-2024, Reliance Infrastructure, RInfra, sat at a complicated crossroads. The company had reduced standalone external debt sharply over the prior year and was signaling a pivot toward growth businesses in defense and engineering, procurement and construction, EPC. Yet, legacy overhangs continued to shadow sentiment, most prominently the August 2024 order by India's markets regulator, SEBI, that banned Group Chairman Anil D. Ambani from the securities market for 5 years in a case relating to Reliance Home Finance, a former group entity. In public, Ambani's camp said he was reviewing the order and would take appropriate next steps as legally advised, but questions about governance and capital access were inevitable. The capital commitment. On 20th September 2024, Reliance Infrastructure's board approved the first tranche of a much larger 6,000 crore rupees equity raising program, designed as a mix of preferential allotment and potential qualified institutional placement (QIP). This initial step comprised a rupees 3,014.4 crore preferential issue of up to 12.56 crore equity shares warrants at rupees 240 per share. Within this structure, the promoter group, acting through Reliance Infinity Private Limited, committed approximately rupees 1,104 crore, subscribing to 4.60 crore shares. This represented the single largest chunk of the raise and signaled a direct sponsor-backed endorsement at a time when markets were weighing the SEBI order against the group chairman. The capital plan also brought in two marquee external investors: Fortune Financial and Equities Services, Nimish Shah's entity, subscribing to roughly 4.41 crore shares, contributing around rupees 1,058 crore. Florent Tree Innovations LLP, led by Matthew Syriac, former Blackstone India co-head, committing about 3.55 crore shares worth rupees 852 crore. Together, these investors covered the remaining rupees 1,910 crore, providing not just financial heft but reputational credibility. Following the board nod, the issue was taken to shareholders for approval via an extraordinary general meeting and postal ballot. By 21st October 2024, the company secured overwhelming shareholder consent, with disclosures noting that promoter holdings would rise post-issue, while external institutional participation would diversify the cap table. The preferential allotment was structured with 25% upfront payment and the balance payable on warrant conversion, aligning promoter and investor commitment with execution milestones. This staged structure also ensured that follow-on capital would enter only if early turnaround signals materialized, reducing risk of announce and abandon optics. Company filings emphasized three intended uses: deleveraging to achieve near zero standalone debt, enhancing net worth to improve credit ratings and bonding capacity, funding growth in EPC and defense projects via subsidiaries and joint ventures. The combination of sponsor-led infusion, credible co-investors, and shareholder backing created what analysts described as the most decisive capital commitment to our infra in over a decade, putting it on a more stable footing to re-engage with banks, rating agencies, and counterparties. Why this move? Why now? In the years leading up to the September 2024 capital raise, Reliance Infrastructure had made measurable progress in reducing its debt burden, but remained in a fragile equilibrium. From a peak consolidated debt of over Rs 45,000 crore in FY18, the company had whittled down its standalone external debt to near zero by mid-2024, aided by asset monetizations, notably the Rs 18,800 crore sale of its power transmission assets to Adani Transmission in 2018, and aggressive deleveraging through claim settlements. Even so, consolidated borrowings on subsidiaries and joint ventures kept leverage elevated, constraining access to fresh working capital lines. At the same time, RInfra was vocal about pivoting to growth businesses in engineering, procurement, and construction, EPC, and defense manufacturing, areas where India's infrastructure push and the government's Atmanirbhar Bharat program were generating large project pipelines. Between FY22 and FY24, the company announced EPC order wins exceeding Rs 15,000 crore. But execution required upfront bonding lines and milestone-based liquidity buffers. In several bids, the company risked being disqualified unless it could demonstrate stronger net worth and reduce leverage. External headwinds made the timing more urgent. The August 2024 SEBI order banning Anil Ambani for 5 years from the securities market created a credibility cloud that threatened to spill over into counterparty negotiations. Although the order pertained to Reliance Home Finance, no longer part of the group, its reputational spillover was inescapable. Analysts warned that unless RInfra could quickly demonstrate capital strength and governance alignment, the cost of borrowing and vendor terms could deteriorate further. In parallel, credit markets were rewarding deleveraged infra players. Peers that had completed balance sheet cleanups, such as L&T in EPC and HAL in defense, were trading at higher multiples, attracting institutional flows. For RInfra, a visible equity raise offered a way to reset its positioning both in terms of market perception and rating agency dialogue. Thus, the Rs 1,104 crore promoter infusion via RIC Infinity, accompanied by Rs 1,910 crore from external investors, was not simply opportunistic. It was a calculated intervention designed to demonstrate promoter skin in the game despite regulatory headwinds, ensure the company could bid competitively in upcoming EPC defense tenders worth thousands of crores, lay the groundwork for a second stage raise via qualified institutional placement once rating upgrades and early execution traction materialized, send a message to lenders, vendors, and regulators that the promoters were committed to sustaining the listed entity, not just stabilizing it temporarily. By sequencing the raise at this juncture, RInfra attempted to convert a moment of vulnerability into one of renewal, stabilizing its balance sheet, shoring up reputation, and creating optionality for future growth capital. The mechanics and milestones. The capital program unfolded in a sequence of tightly choreographed steps. On 20th September 2024, Reliance Infrastructure's board approved the preferential allotment of up to 12.56 crore equity shares warrants at Rs 240 per share, amounting to Rs 3014.4 crore. The pricing represented only a modest premium over the prevailing market price, making the issue both attractive to investors and defensible in terms of fairness under SEBI's preferential issue regulations. Within a month, on 21st October 2024, shareholders gave their consent through a postal ballot, clearing the regulatory hurdle and formally endorsing the promoter's plan. The company's exchange filings noted that promoter holding, which stood at around 22.96% pre-issue, would increase following the subscription of 4.60 crore shares, Rs 1,104 crore, through RInfra Infinity. Simultaneously, new institutional participants, Florentry and Fortune Financial, were slated to collectively acquire close to 8 crore shares, diversifying the register and anchoring credibility. The structure of the issuance was also noteworthy. Investors were required to pay 25% upfront at the time of allotment, with a balance payable upon warrant conversion within 18 months. This mechanism staggered cash inflows while binding investors into a longer-term relationship, aligning their commitment with the company's operational progress. The promoters demonstrated urgency in execution. In June 2025, filings confirmed that RInfra Infinity had accelerated the conversion of 1.25 crore warrants into equity shares, bringing in additional capital ahead of schedule. This early conversion, amounting to nearly Rs 300 crore, was interpreted by analysts as a signal of sponsor confidence and reduced execution risk. Meanwhile, the inflows began to show up in external validation. In July 2025, India Ratings and Research upgraded Reliance Infrastructure by 3 notches, from INDC to INDB stable. INDA4, explicitly citing the improved equity base, deleveraging efforts, and a track record of timely debt servicing in FY 24 to 25. The agency highlighted that standalone debt had been reduced to near zero, giving the company headroom for working capital borrowings tied to new projects. Market response mirrored these milestones. On the day of the board approval in September 2024, RInfra's stock price rallied by over 9% intraday, closing at Rs 241.50 on the BSE, as investors priced in the capital relief and the prospect of near-zero debt. By the time warrant conversions were disclosed in mid-2025, the stock was trading at a sustained premium over the issue price, validating both the timing and structuring of the raise. Together, these steps, board nod, shareholder vote, upfront funding, accelerated conversions, and ratings upgrades, transformed the infusion from a mere announcement into a tangible sequence of milestones. Each stage carried its own signaling value: board approval for intent, shareholder nod for legitimacy, warrant structure for alignment, early conversion for confidence, and rating upgrade for external validation. The cost of capital providers. The credibility of Reliance Infrastructure's capital program hinged not just on the size of the infusion, but also on who was writing the checks. The presence of seasoned external investors alongside the promoters was critical in assuaging market concerns about governance, pricing, and long-term alignment. The first anchor was Fortune Financial and Equities Services, a financial services company with roots in institutional broking and investment advisory. Controlled by industry veteran Nimish Shah, Fortune had previously participated in stressed and special situation investments, earning a reputation as a countercyclical, high-risk appetite player. In the RInfra deal, Fortune committed roughly Rs 1,058 crore, subscribing to around 4.41 crore shares. Market commentators noted that this was among the largest single equity commitments Fortune had made in an infrastructure platform, signaling a conviction that the balance sheet reset was real. The second anchor was Florentry Innovations LLP, led by Matthew Syriac, the former co-head of Blackstone India. Syriac had built Florintree into a boutique investment platform focused on growth and turnaround stories in sectors like financial services, technology, and infrastructure. Florintree brought in around rupees 852 crore by subscribing to 3.55 crore shares, positioning itself as a patient but active investor. Syriac's track record at Blackstone, where he was involved in multi-billion-dollar infrastructure and corporate deals, added weight to Florintree's involvement. Analysts interpreted Florintree's participation as a validation of governance progress, since Syriac's reputation for due diligence suggested that institutional-level scrutiny had been applied. For the promoter side, the infusion came through Reliance Infinity Private Limited, an entity within the Reliance Ada Group's promoter ecosystem. By committing rupees 1,104 crore via 4.60 crore shares, Reliance Infinity ensured that promoters were visibly aligned with external investors, countering criticism that promoter funds had been too thin in prior restructuring. Exchange disclosures confirmed that promoter shareholding in RInfra would increase post-issue, reducing concerns about excessive dilution. The synergy of the cost mattered as much as the capital quantum. The promoter infusion sent a message of skin in the game. Fortune Financial brought risk capital with an opportunistic return profile. Florintree supplied institutional credibility and long-cycle capital. Together, this trio created a capital stack blending sponsor alignment, high-risk appetite, and institutional discipline. For banks, vendors, and rating agencies, it demonstrated that the company was no longer solely reliant on internal family capital, but was attracting third-party money with its own reputational checks and balances. By October 2024, when shareholder approval was secured, analysts began describing the lineup as the most balanced capital provider mix seen in an Anil Ambani Group entity in over a decade, a sharp contrast to earlier rescues that had leaned heavily on asset sales or debt restructuring without strong external equity participation. The immediate aftermath in the market. The board's announcement on 20th September 2024 triggered an immediate and visible response in the capital markets. Reliance Infrastructure's stock price on the BSE surged intraday by more than 9%, closing at Rs 241.50, slightly above the preferential issue price of Rs 240. Trading volumes spiked to nearly 5 times the 30-day average, suggesting broad-based investor participation rather than just speculative churn. Financial media captured the optimism with headlines that emphasized near-zero debt and the scale of the promoter commitment. Analysts highlighted two aspects. First, the structuring of the preferential issue with staggered warrant payments, which aligned cash inflows with operational milestones, and second, the credibility of external investors like Florintree and Fortune Financial, who had reputationally much to lose if the governance environment did not hold. Brokerage notes in the weeks that followed reflected a cautious optimism. A mid-year brokerage report observed, the preferential issue addresses RInfra's immediate balance sheet concerns and provides flexibility in bidding for large EPC orders. However, execution discipline remains the critical variable. Another added that the infusion could help the company unlock claims receivables of over 6,000 crore rupees currently under arbitration, a point the management had stressed in prior investor presentations. By October 2024, when shareholders formally approved the allotment through a postal ballot, the stock had stabilized at levels around Rs 242,250, effectively validating the issue price. The shareholding disclosures released after the approval also reassured investors that promoter stake would rise post-issue rather than dilute further, a concern that had weighed on the scrip in earlier years. The positive momentum carried into early 2025, reinforced by the accelerated warrant conversion by Reliance Infinity in June 2025 and the India Ratings 3-notch upgrade in July 2025. Analysts saw these as follow-through milestones, reducing fears that the preferential issue was a one-off cosmetic exercise. By mid-2025, RInfra stock was consistently trading at a premium of 15-20% above the issue price, signaling the market was willing to look past near-term uncertainties and bet on the turnaround story. The immediate aftermath thus combined a relief rally, stronger investor dialogue, and a narrative shift from one dominated by regulatory overhang to one framed around capital stability and future growth. Yet the tone of analyst commentary remained measured. Markets had rewarded the decisive capital action, but were waiting for execution proof in the company's order book conversion and claim recoveries. Voices that shaped the narrative. The story of Reliance Infrastructure's capital reset was carried not just through balance sheets and filings, but also through carefully chosen voices in the public domain. From the company's side, the messaging was simple and emphatic. In its exchange filing on 20th September 2024, RInfra declared that the preferential issue would enhance the company's net worth, reduce debt to near zero at standalone level, and fund future growth in EPC and defense businesses. The repeated invocation of near zero debt became a soundbite picked up widely in business media, reinforcing the image of a company finally lifting the overhang of leverage that had long constrained it. On the governance front, however, the narrative was more complicated. Just weeks before the preferential issue was announced, the Securities and Exchange Board of India, SEBI, had barred Anil Ambani from the securities market for 5 years in a case tied to Reliance Home Finance. A spokesperson for Ambani responded carefully, he was reviewing the order and will take appropriate next steps as legally advised. The neutral, legalistic tone suggested the promoters were intent on keeping the regulatory matter at arm's length from RInfra's fundraising exercise. Market commentators provided their own framing. A report in the Economic Times noted the equity infusion backed by both promoters and marquee investors like Florentry could be the clearest signal in years that RInfra is committed to repairing its balance sheet. Yet regulatory headlines cannot be ignored. Another analyst quoted in Business Standard added, external investors with reputational skin in the game reduce the perception that this is a purely promoter-driven bailout. Ratings agencies later amplified this mixed but forward-looking tone. When India Ratings and Research upgraded RInfra by 3 notches in July 2025, it observed that the improvement stemmed from deleveraging through equity infusions, reduction of standalone debt to near zero, and improved debt servicing track record. By citing equity commitments and sponsor support alongside operational performance, the agency's commentary provided institutional validation to the company's narrative. Even regulators acknowledged the balance between compliance and capital. Though SEBI's order stood, sources quoted in financial media stressed that the regulator's ban was limited to Ambani personally, not to the functioning of Reliance Infrastructure, a nuance that allowed the capital raise to proceed unhindered. In sum, the voices shaping the narrative came from multiple spheres: corporate filings and spokespeople emphasizing deleveraging and growth, promoter representatives signaling compliance and caution, external investors and analysts balancing optimism with skepticism, ratings agencies translating equity moves into credit upgrades, regulators delineating individual culpability from corporate continuity. Together, these voices created a layered story: one part capital ambition, one part reputational repair, and one part cautious external validation. What changed on the ground? The infusion of over 1,100 crore rupees was not merely a balance sheet adjustment. It reshaped how Reliance Infrastructure operated at the ground level. By December 2024, the company reported that standalone debt had been reduced to near zero, a development that immediately freed up management bandwidth previously consumed by negotiations with lenders and rating agencies. The deleveraging also allowed RInfra to secure better terms for bank guarantees, an essential lifeline in the EPC sector where project awards hinge on financial credibility. Operationally, the impact became visible in 2 distinct areas. First, the company began accelerating its claims recovery efforts with more than 6,000 crore rupees tied up in arbitration cases with government and quasi-government agencies. Freed from the shadow of pressing debt obligations, RInfra could now afford to pursue these claims more aggressively, engaging legal and financial advisors to speed up settlements. In early 2025, management disclosed progress on certain claims nearing resolution, which could further strengthen cash flows. Second, with promoter equity support and external investors' endorsement, RInfra was able to re-engage with government stakeholders on future infrastructure opportunities. The Ministry of Defence, which had earlier been cautious about awarding large contracts due to the group's financial stress, reopened dialogue on strategic defence EPC work. Similarly, state electricity boards showed greater willingness to contract with RInfra's power distribution arm, reassured by the improved credit standing. The company's operational narrative was reinforced by independent recognition. In July 2025, India Ratings and Research upgraded RInfra's rating by 3 notches, explicitly citing improved debt servicing capability, deleveraging through equity infusion, and stable cash accruals. This was not merely symbolic, it directly lowered the cost of bank guarantees and working capital facilities, giving the company tangible breathing space to compete for larger projects. For employees too, the mood shifted. After years of uncertainty, delayed payments, and talk of asset sales, there was visible morale improvement. Managers reported greater stability in project execution teams and an uptick in applications from engineers and project managers who had earlier shied away from a company seen as financially distressed. By mid-2025, the effects of the recapitalization could be traced to bid books and site-level activity. RInfra was once again present in pre-qualification bids for urban transport projects, highway packages, and defense infrastructure tenders. While not all of these would immediately convert to revenues, the ability to participate on equal footing with peers like L&T and Afcons marked a break from the retreat posture of earlier years. In short, what changed on the ground was both perceptual and practical. Vendors were more confident in extending credit, regulators more open to approvals, lenders more flexible on facilities, and employees more engaged in projects. The infusion had moved the company from mere survival to a platform where growth was once again plausible. The external scorecard. The true test of Reliance Infrastructure's turnaround did not lie in its internal confidence, but in how external observers scored its progress. On the capital markets front, the company's stock delivered a sharp rebound. From around rupees 150 per share in early September 2024, RInfra's price surged to over rupees 300 by November 2024, coinciding with announcements of promoter infusion through RIC Infinity and the entry of marquee investors such as Florentry Advisors and Fortune Group. Trading volumes spiked, signaling that retail and institutional investors alike were re-rating the company. Analysts framed the equity issue as credible evidence of promoter commitment, a factor that softened long-standing skepticism. Credit rating agencies provided perhaps the most significant validation. In July 2025, India Ratings and Research, INRA, upgraded RInfra's long-term issuer rating by 3 notches, from in D to in BBB-. The agency's report explicitly mentioned deleveraging through equity infusion, improved debt servicing track record, and the possibility of arbitration claim realizations as drivers of the upgrade. This upgrade shifted the company from the default category into investment-grade territory, transforming its access to project financing. Regulatory observers also played a role. While SEBI's order against Anil Ambani remained a reputational overhang, the regulator clarified that the ban was personal, not corporate, ensuring RInfra's transactions and fundraising remained compliant. This distinction helped banks and counterparties continue to transact with the company without breaching norms. In fact, a senior banking executive was quoted in Mint saying, "The promoter's equity injection is a confidence signal. We are now more comfortable with extending guarantees for new EPC contracts." Institutional investors reinforced the scorecard effect. Matthew Syriac of Florentry Advisors, in media commentary, underlined that his fund's participation was based on a long-term belief in the EPC and defense potential of RInfra once leverage stops being a constraint. Similarly, Nimish Shah of Fortune Group highlighted that external investors viewed the company as a turnaround opportunity with significant upside if arbitration claims were unlocked. The financial press tracked these changes closely. Business Standard, in a December 2024 piece headlined "Reliance Infra Back in the Game," wrote, "A clean balance sheet, marquee backers, and credit upgrades are altering the perception of a company that was once synonymous with distress." The credibility RInfra gained stood in sharp contrast to other players in India's over-leveraged infrastructure universe. IL and FS, once a giant, had collapsed into systemic crisis by 2018, leading to government intervention, board supersession, and a multi-year resolution process that wiped out equity investors. GMR Infrastructure, though it managed to stabilize, went through repeated debt restructuring, asset divestments, and promoter stake dilution, with rating upgrades coming only much later and in smaller steps. JP Group, burdened with stalled real estate projects and unresolved debts, remained a cautionary tale of how prolonged distress erodes both market confidence and operating capacity. Unlike these cases, Reliance Infra's narrative was distinct. Promoter-led equity injection combined with external institutional participation produced a faster reputational repair cycle. Within 12 months, the company had moved from distress discount territory into a position where it was once again considered a credible contender for fresh EPC and defense contracts. By mid-2025, the external scorecard thus reflected three layers: markets rewarding the stock with higher valuation, rating agencies validating the creditworthiness, and institutional investors offering reputational capital. Each of these built on the other, creating a reinforcing cycle of external confidence that the company had not enjoyed in nearly a decade. Execution risks that did not disappear. While the 1,104 crore rupees promoter infusion through RIC Infinity and the broader rupees 3,014 crore preferential allotment significantly stabilized Reliance Infrastructure, several execution risks remained materially relevant. Long project cycles. RInfra's focus on EPC and defense projects involves contracts with multi-year execution horizons. Delays in project approvals, land acquisition, or government clearances could erode the financial benefits of the capital infusion. For instance, large metro rail and highway EPC packages often take 18 to 36 months from award to revenue realization. Any slippage could strain working capital, despite the improved balance sheet, arbitration, and claims realization. While the company had rupees 6,000 plus crore of claims under arbitration, there was no certainty on timing or quantum of recovery. Delays or partial realizations could reduce the cash flow cushion intended to support growth. Analysts warned that equity infusion reduces immediate liquidity stress, but does not accelerate claim adjudication, emphasizing the residual risk. Governance overhang. The SEBI ban against Anil Ambani remained a reputational constraint. Though it was personal and not corporate, banks, institutional partners, and international counterparties continued to factor the overhang into their risk assessment. Anecdotal reports from Q4 2024 suggested some lenders required additional counterparty risk mitigation when issuing bank guarantees for new contracts. Market and competitive pressure. Competitors such as L&T, Afcons, and Tata Projects remained aggressive in EPC and defense bidding. RInfra needed not only liquidity but also execution discipline, project management efficiency, and timely bonding to ensure competitiveness. Any lapse could result in lost contracts, negating the advantage of the recent capital infusion. Dependency on institutional support. While marquee investors like Florentry and Fortune Financial enhanced credibility, their continued engagement was partly contingent on the company demonstrating timely project execution and claim recoveries. Failure to deliver on these milestones could strain investor confidence and impact potential future raises, such as a QIP planned for later 2025. Sectoral volatility. Infrastructure and defense segments are sensitive to macroeconomic shifts, policy changes, and budget allocations. Unanticipated changes in government capex, interest rates, or bond yields could affect project financing costs and internal project IRRs, introducing execution and financial risk even after deleveraging. In summary, while the capital infusion resolved immediate liquidity and solvency concerns, the company continued to face operational, financial, and reputational risks. The turnaround was no longer just a balance sheet exercise. It required sustained project execution, timely claim realization, stakeholder confidence, and disciplined governance. The strategic thread running through the actions. Beneath the series of capital infusions, preferential allotments, and operational realignments, there was a cohesive strategic intent that guided Reliance Infrastructure's turnaround approach. The moves were not random or reactive. Rather, they were sequenced to stabilize, reassure, and re-enable growth. Stabilize the balance sheet first. The immediate priority was liquidity and solvency. By committing 1,104 crore rupees through Reliance Infinity and bringing in marquee investors like Florentry and Fortune Financial, RInfra reduced standalone debt to near zero by December 2024, creating headroom for working capital and project bonding. This stabilization was critical to restore confidence among banks, vendors, and rating agencies, effectively unlocking the next stage of strategic execution. Align stakeholders through transparent governance. The involvement of external institutional investors provided a reputational check on the promoters, ensuring that governance standards were visible to all stakeholders. Board approvals, shareholder votes, and staged warrant conversions reinforced transparency, sending a clear signal that the turnaround was not merely cosmetic, but backed by skin-in-the-game commitment and institutional scrutiny. Prioritize core growth areas. With financial stability restored, RInfra focused on EPC and defense projects, sectors aligned with India's infrastructure expansion and Atmanirbhar Bharat initiatives. The preferential issue enabled the company to participate competitively in bids requiring high bonding capacity, a step that would have been impossible under prior debt constraints. This move reflected a deliberate strategic pivot from legacy businesses towards sectors with predictable long-term revenue potential. Create milestones that validate credibility. Every action, the board nod, shareholder approval, staggered equity infusion, early warrant conversion, and India ratings upgrade served a dual purpose: addressing operational needs while signaling progress to external stakeholders. By sequencing milestones, RInfra ensured that credibility was earned incrementally, building trust with lenders, regulators, and the market. Maintain optionality for future growth. Finally, the strategic thread ensured that RInfra retained the flexibility to raise further capital via QIP or other mechanisms contingent on demonstrating successful project execution and claim realizations. This optionality allowed the company to plan for both organic growth and selective acquisitions without over-leveraging, positioning it to compete on equal footing with peers like L&T, Afcons, and Tata Projects. In essence, the capital infusion, governance alignment, and operational focus were interconnected. Each step reinforced the next, creating a coherent path from stabilization to credibility restoration to sustainable growth. Analysts noted that unlike prior interventions, which had relied heavily on asset sales or debt rescheduling alone, this approach integrated financial, operational, and reputational levers, a holistic thread that underpinned the company's renewed positioning in the market. Road ahead. By mid-2025, two data points suggested that promise was edging toward proof: the accelerated warrant conversion by Reliance Infinity, fresh cash in, faster than necessary, and the ratings uplift. Taken together, they marked sponsor resolve and outside validation. Still, in a sector where projects stretch over years, the more definitive verdict would arrive only as revenue converted to cash. Claims were settled on schedule, and working capital turns improved into habit rather than a quarter's anomaly. About the case author. Dr. KBS Kumar is an award-winning management author and educator with over 100 published case studies across business domains and more than 20 international accolades in case writing. A seasoned trainer and mentor, he has guided corporate leaders, academics, and students in mastering case writing and case-based learning, blending academic rigor with practical insights. Through the case verse, Dr. Kumar transforms real-world business events into engaging case studies, powerful resources for classrooms, corporate training, managerial development, and strategic thinking. Passionate about nurturing critical and analytical skills, his work bridges theory and practice, offering timeless lessons for navigating today's complex business world.